Okay, so we've officially come to the end of the Roaring 20s. So now we're going to be starting basically the last section of this unit. The very last section is the New Deal. But that's basically part of the Great Depression also. So you can sort of think of them together or separate, whatever's easier for you. But we are going to be starting the Great Depression today. So the last president that we talked about was Calvin Coolidge, remember Silent Cal, who became president when President Warren Harding died of a stroke in office. Now, both of them were Republicans, remember, and their number one priority was the economy. So they kept, Andrew Mellon on as the Secretary of Treasury, kept big businesses as the number one priority, continued that theory and practice of laissez-faire economics, and we really saw the economy boom. So Americans were really happy overall with Republican leadership in the White House as well as in Congress, since the Republicans controlled both houses of Congress at the time also. So it wasn't very difficult for the next Republican candidate to win election, and that was Herbert Hoover. And you can see on that electoral map, he wins an overwhelming majority of the states. There's only 7 states there. Okay, I see Rhode Island. So 8 states that don't vote for Herbert Hoover out of the 48 that we had at the time. So 40 states do go to Herbert Hoover. So he easily wins election in 1928. Now, I've talked about farmers a little bit before in this unit, and I've said that, I've said before that the Great Depression starts early for farmers. They have been experiencing difficult economic times really since the Civil War. It's just sort of been an on and off type of thing. They got a brief break in World War I because farmers were hit with very high demand. So to keep up with that demand, they increased production, bought more land, more expensive equipment, things like that. So a lot of them racked up a lot of debt in order to do that, but they were doing it on the promise that demand was high and that they were going to continue making that money. When the war ended, demand fell. So they started making less money. Unfortunately, farmers kept overproducing and ended up with a huge surplus, which drove prices down even more. So farmers really weren't able to pay off their mortgages on their land. They weren't able to pay off their new equipment. And so really, throughout the 1920s, farmers are going to be really struggling economically, have a difficult time making ends meet. So we're going to see a lot of foreclosures and homelessness for our farmers in 1920. The distribution of wealth in the 1920s is also another cause of the Great Depression. It's a very it's more of a long-term cause, but it's definitely a big one. So I've said already, that we're the largest creditor in the world. The United States is the largest or the most industrial, and we're the wealthiest. And with all of that industry, you would expect to see wages of employees increase and corporate profits increase, and both do as productivity goes up. Corporate profits increase in the 1920s by about 65 to 70%, which is really, really high. So you would expect to see wages increase by a similar percentage, but wages in the 1920s only increased by about 8%. So we're seeing the rich become filthy rich, and the poor are sort of just becoming less poor. So everyone is on this economic ladder trying to work their way up to the top. And while everyone's moving up the ladder, the people at the top, the wealthier, they're moving up the ladder so much faster. And because of that, the gap between the poor and the wealthy is getting bigger and bigger all the time, and that's our distribution of wealth. And the problem is that when you're poor and you're wealthy get too far away from each other, the wealthy can't spend enough money to bridge that gap, and they can't spend enough money to sort of make up for the small size of the middle and lower class, and they can't spend enough money to keep businesses going because there is not as many of them as there are of the lower class. So that's going to cause a big problem. On top of that, all of this is being built on top of a mountain of debt. Our entire economic stability is really just a false sense of security. Installment payments became very common for most Americans in the 1920s. So a lot of Americans are digging themselves further and further into debt for the first time, and they don't really care because they've never seen the downside of having a really big credit debt. And they're buying everything. They're buying stocks with credit. They're investing in companies. They're buying refrigerators. They're buying cars. They're doing everything they can do on credit. And so companies are appearing to make money, but they're really just making the promise of money. Because while the upper class can pay it right off, the middle class doing these installment payments, they're pretty much just saying, I promise that I will pay this off. There's no guarantee that they actually will. So it's a lot less secure than buying something and paying totally up front. So building all of this on credit is also another really big cause of the Great Depression. So most people, when they think of the Great Depression, they immediately think of the stock market crash, and that's definitely the biggest thing that we can point to and say, yes, right there, that's when the Great Depression starts. So the way that stocks work is that when you buy shares in a company, you're investing in that company, and you're doing it on the hopes that that company will use your money to, I don't know, invest in new technology, do whatever, expand, and that they will make more money, so the company will do well, which will cause the price of stock to go up, which means that when you sell back the stock that you originally bought, you can sell it at a higher price that you bought it at, and you can make a profit. Now, everyone at this time was interested in buying stock, but not everyone has the head for economics. Not everyone knows which companies are worth investing in. Not everyone knows how to read the stock market. So you go through a stockbroker, and it's that person's entire job to know the stock market and to know the publicly traded companies and to be able to say, you should invest your money in this one over this one because it's a more secure investment, or it comes with a higher possible return on your investment, or something like that. Now, brokers don't know for sure what the right move is. There's no sure thing, no such thing as a sure thing in the stock exchange. And if brokers are telling you that something is a sure thing, they're lying. Brokers are also guessing, just like you would be if you tried to buy stock. Brokers, granted, are making a much, much more educated guess than the average American would be if they did it on their own. But they are guessing nevertheless. And so that's called speculation, when brokers are guessing which stocks are going to rise and which stocks are going to fall. That's stock speculation. And in the 1920s, we see way too many people buying into guesses. Way too many people are spending money based on speculation. And now stocks are really a self-fulfilling prophecy. If I'm a broker and I speculate that prices in stock are going to rise in a particular company, and I tell all of my clients that they're all going to buy stock in that company. And when everyone's buying stock in a particular company, it's going to drive the price of the stock up. So this price is going to rise. So in that capacity, it's a self-fulfilling prophecy. And the same way around, if I tell everyone that I think this stock is going to fall, people are going to sell their shares, which is going to drive down the price, which is going to make the stock fall. So brokers and their guesses, they have a really large impact on the appearance of the stock market, but it doesn't necessarily tell us the truth about a company. I could just be making it up that a company stock is going to go up. It doesn't necessarily mean that that company has a bright future. That company could be days away from bankruptcy, and I could just sort of be making that up. I might not have even gone to work today. I might have just called in on the phone and said, I think the price of whatever Google's going to go up. It doesn't necessarily mean that it is going to go up because they're making more money. I'm just saying that because I'm trying to make a commission off of selling stock. So eventually, reality will catch up with that speculation, and we will see stock prices level out or plateau, basically beginning to reflect a more accurate idea of each of these companies. So stock prices have been sort of continuously rising on and off throughout the 1920s, but in the fall of 1929, things begin to stall and then fall slowly, in the beginning of September. And when that happens, if you've bought a bunch of stock and prices have been rising and rising and rising, and you've been holding off on selling your shares to make the most amount of money possible, when stocks begin to stall or go down, that signals to you, hey, it's time to sell, because if prices get too low, then you might end up losing money. So people start selling, more and more people are going to start selling their stock throughout September and October. But as more people sell their stock, the lower the price of that stock gets, which causes the stock market to look like it's in free fall. So on October 23rd, the Dow Jones, which is sort of like the average stock of the top 5 that we have at the time. So when we say the Dow is up, that's us basically giving us sort of like a general idea of how the stock market is doing. When the Dow is down, that's giving us a general idea that the stock market overall isn't doing well. So on October 23rd of 1929, the Dow Jones fell 21 points. Today, if the Dow Jones fell 21 points, it wouldn't be a big deal. Today, if the Dow falls and it makes the news, it falls by like 300 points. So our inflation and stuff has really affected that. So don't think that if you see that the Dow just dropped 20 points, yesterday or today, that means that we're on the verge of the apocalypse. It's not true. But back then, the Dow falling 21 points in a day was a really big freaking deal. So the next day we call Black Thursday, because that day prices kept falling and buyers were nervous, so they started selling like mad. And by the end of the day, GE, for example, General Electric, their price per stock was cut in half by the end of the day. So over the weekend, more and more people are getting nervous. And so on Tuesday, Black Tuesday, October 29th, more than 16 million shares of stock are sold, and they're sold at bottom prices. And that's when the stock market we can say that it has officially crashed. Now, the immediate impact of the stock market crashing is that a lot of these big investors are losing billions of dollars. On top of that, Americans who had bought on the margin, so buying stock on credit, they've also essentially lost everything. So this is a really big issue. And so by November, the Dow had gone from $381 a share to less than $200 a share. So we see a big difference there. Now, the first thing to feel the effects of the stock market crash is going to be banks. Banks don't actually have all your money in a giant vault in the back. They use your money, to give out loans to people because they know that not everyone's going to show up to collect their money on the same day. Now, as the market falls, people get nervous. They want their money in their hands where they know it's safe. So millions of people start running to the banks to withdraw all their money. When this happens, the bank runs out of money before everyone has actually collected it all, because they've given a lot of it out in loans. So people at the back of the line don't get any of their money. And then when the bank is out of money and they still owe people, we say that the bank has failed and people lose pretty much whatever was left. In 1929 alone, 641 banks fail. In 1930, another 1,400 fail. In 1931, another 1,700 fail. So we're seeing thousands and thousands of banks go under. So that means we're seeing millions of people losing money, potentially losing all their money, their entire life savings. And as more banks fail, more people feel not secure about banks and the banking system, so they'll continue to withdraw their money, which will cause more banks to fail. So it's sort of a snowball effect that no one can really stop at this point, and things are just going to continue to get more and more out of hand as the days go on.